The main mandate is to introduce domestic natural gas, and the reason for doing that in the long term is that its cost will be on a downward trend over time compared to any imported feedstock. And also it is our own resource, so it insulates us a little bit from external market forces. But that's the main mandate, but that mandate cannot be fulfilled unless there is space in our economy to consume gas. And right now, there isn't. Even if we had access to ample resources of natural gas, we don't really have a place for it, other than at this point in time, just one power station. All of the others need a certain amount of work. So what we are looking at doing is availing of the current market conditions externally. In other words, gas prices have dropped, LNG prices have dropped, parcels have shrunk in size, tenures of contracts have shortened, cost of infrastructure has decreased, which actually make the delivered landed cost of gas in Sri Lanka, which is LNG imported, regasified, and delivered to the point of consumption, is now competitive with that of coal. So the advantage in using those market conditions right now is that you create demand. And when you create demand, the unit cost of domestic gas when it enters the market also drops, because you're spreading it over a bigger demand portfolio. So it's a very compelling case right now to start gasifying Sri Lanka using initially imported LNG, and then at some point in the future when it's technically available, phasing into domestic gas. So in summary, we are very supportive of that strategy. Kerawalapitia, for example, it has its gas modules in place. It really doesn't take much to convert Kerawalapitia to be fired using natural gas. You need to plumb the gas into the power plant, and really that's about it. I think the plant owners tell us that it'll take them 24 hours to shall we say, commission their gas modules. The gas modules are already in place. So maybe a few days, maybe a few weeks, but a short period of time to have the whole supply chain lined up. But there are some advantages in doing that for them as well as for us, because it allows them to use that plant at full capacity. That plant is now not running at full capacity because it's using liquid fuels, and those have an erosional impact on the turbine blades. So when the turbines are fired by gas, they can pump it up to 330 megawatts, which is its actual nominal output. The 2Gs are 165 and 165 turbines. So that of course adds another 50 megawatts to the grid. So there are some intrinsic advantages. Plus the downtime isn't very much compared to having liquid fired turbines, because you need to refurbish the turbine blades. So in the other plants, AES and Kalanithista, they will actually need to be commissioned for gas service, and gas modules installed. That may take anything between 3 and 6 months, but it can be planned for and executed. I can't tell you the cost of the conversion. In the Kerawalapitia case, I'm fairly sure it's not a huge incremental cost. I don't know about the others, but it's certainly feasible, because you're talking about a very small incremental change in capacity charge over a long period of time. Because when you recommission to gas, then you're also doing a little bit of you're extending the life of the plant in general. I don't think the cost is the barrier. The barriers in planning such things are assurance of feedstock. They need to be sure that when you make that conversion, that gas is there for as long as you need it. And also there's the business of actually achieving a plant factor that will support the economics of the conversion. So that depends on who's investing. If it's a government investment, then the government investment perhaps can take a little downtime. But if it's a private investor, then the private investor is going to want to have his plant factor as high as possible to support the economics that they originally planned for.